Hello friends. Imagine having a colossal pot of money and the power to supercharge businesses, taking them from local heroes to global giants. That's the world of private equity in a nutshell. But wait, there's more to this financial wizardry than meets the eye. Now let's break it down a bit. Private equity, or PE for short, isn't just a bunch of wealthy folks buying up companies left, right and center. It's a massive world where different investment strategies collide, all centered around equity investments in companies that aren't listed on public exchanges. Picture it like an enormous market of potential where businesses get the financial muscle they need to skyrocket their growth, all happening behind the curtain, away from the public eye. So how exactly do these financial musterios turn businesses around? Enter buyout funds. Imagine you and your financial savvy friends pooling together your money with one goal in mind. Buy a business, polish it up, and then sell it off for a tidy profit. That's what a private equity firm does, but on a much larger scale. They collect funds from big players, think institutional investors and pension funds, and dive deep into the world of buying, enhancing, and profitably selling these companies. But here's the secret sauce they use, and that's leverage. Imagine buying a house. You don't usually pay the whole amount upfront, right? You pay a part, and for the rest, you get a mortgage. Now transfer this idea to a PE firm, bank company. Let's say there's a company worth $500 million. A PE firm might put down $200 million of its own money and then borrow the rest, say $300 million. If they amp up the company's value and sell it for more, they repay the debt. And everything left after that? Well, that's the juicy profit going back to the investors. But it's not always smooth sailing, and leveraging, while powerful, comes with its own set of perils and complexities. Buckle up. As we venture further, we'll unveil the rocky terrains and tempsets that sometimes shake the seemingly unsaleable world of private equity. Now friends, picture this. For over a decade, the world of private equity has been on a winning streak. Everything's coming up roses. But recently, some dark clouds have appeared. Rising interest rates have thrown a wrench in the work. Why? Well, higher interest rates mean that the money PE funds borrowed becomes more expensive. This makes it challenging when they want to sell the companies they own. Imagine buying a painting for $500 million and later finding out that you can only sell it for $300 million. Ouch. Now that's going to hurt big time. Now these PE giants are in a tight spot. They have promises to keep, big investors who are expecting some solid returns. But selling companies at a loss? Well, that's a tough pill to swallow. But here's a twist. Some PE firms have a plan. They're banking on a new kind of financing called as NAV, or net asset value financing. Think of it as a financial safety net. Instead of borrowing against a single company, they borrow against their entire portfolio. It's like betting on the overall health of a forest rather than betting on one single tree. Sounds clever, right? But here's the catch. Some of these NAV loans have sky-high interest rates, touching even as high as 19%. That's like walking on a financial tightrope. While this move is definitely creative, it's more a band-aid than an actual cure. And you know what's surprising? The newbies of the PE world think it's all business as usual. But for the old guards, this feels eerily familiar, kind of like the risky moves that led to some of the big financial meltdowns in the past. Imagine a game of Jenga, each block a decision stacked meticulously, one after the other, aiming for towering success, but always risking the crash. Welcome to the world of private equity and the tightrope of walking on leverage. In the last several decades, the financial industry, especially the private equity industry, or PE for short, has been playing its own high-stakes game of Jenga, weaving through cycles of risk and reward. When the chips stack up in their favor and the reward is mesmerizing, and thus they dive back right tighten, ever more daring, pushing the boundary of risk further and further. Now picture the 2008 financial crisis. The financial world is quaking under its own weight, and yet, like a phoenix, the private equity firms rise from the ashes of a crashing market, thanks to a little help from the government bailouts and a strategy known as quantitative easing or QE. Fast forward to 2020, the world gripped by the global pandemic, and again a similar playbook emerges with huge financial aids trying to keep the economy afloat. Now let's dive into the intricate world of PE financing, visualizing it as a three-tiered fountain where money flows through various layers, each with its own function and risk. At the very base or bottom, we have company level debt, the traditional borrowing against a company's assets. In the middle, we have something known as NAV financing at the fund level, causing quite a stir amongst the financial pundits for its daring risk profile. And at the very top, a delicate and relatively new tier called as management company loans, or ManCos for short, where the management company itself becomes indebted, funding its ventures based on fees and profits from the below tiers. Imagine, if you will, that one of these underlying companies, one of these crucial blocks, falters in a challenging economic climate. That misstep can reverberate upwards, jeopardizing the stability of the whole structure. A singular failure potentially spiraling into a cascade of financial instability. Stay with us as we explore how this precarious Jenga tower, made up of leverage upon leverage, can either skillfully ascend or send tremors to an industry holding a staggering $11 trillion at stake. Peering into the private equity world, it seems calm on the surface, but underneath, the currents of financial complexity and the risk are swirling, presenting a unique scenario that's distinct from the financial crises we've witnessed in the past. In the infamous 2008 crash, the descent into chaos was, for lack of a better word, public, visible. It unraveled before our very eyes, with entities involved and with their failures laid bare for all to scrutinize. Yet, when we shift our gaze to today's private equity industry, we're met with a veil of secrecy, a fortress of less transparency, where the ripple effects of financial missteps might not scream as loudly or become immediately apparent. Now, this presents a peculiar kind of danger. Many lenders to these private equity funds are an intricate web, private equity entities themselves, and they certainly have no appetite to witness the fortress crumble. So if the walls were to start caving in, it's likely to be a slow, stealthy process, punctuated not by dramatic falls, but by careful debt restructurings, hushed negotiations, and behind-the-scenes maneuverings to stave off the stark, rapid downfall. To distill it down, the staggering $11 trillion private equity empire, entwined with pension funds, insurance funds, and mighty institutional investors, looms large in our financial future, and its multi-layered labyrinth structure of finance merits a vigilant watch. However, due to the shadowy, veiled nature of private equity and the deep-seated interests of its major titans, any tremors or potential takedowns in this sector might just unfold with a deceptive, subtly lurking under the surface before its effects are truly felt across the financial landscape. Exploring private equity or PE, we dove into the hidden world where big money moves can turn small businesses into huge ones. But it's not just about success stories. With their secret strategies and heavy borrowing, PE firms can also face risks and challenges, especially when interest rates climb or investments don't go as planned. As we peek into this financial giant worth $11 trillion, the big question remains: will its complex web of money and debt lead to greater heights, or could it tumble if a single piece falls out of place? Let's keep watching and learning together. But now I turn to you. What are your thoughts on this financial behemoth and its future? Your insights matter, and I invite you to share them below, sparking a rich dialogue amongst us. If you found our journey enlightening and crave more deep dives into the financial world, do hit the like button and share this exploration with others who find it fascinating. To ensure ensure you don't miss out on our next financial adventure, subscribe and click the notification bell, and let's keep unraveling the mysteries of finance together. Until then, stay curious, keep exploring, and I'll see you in our next journey through the financial realms. Bye for now.